September 18, 1958. Bank of America executives gathered in a Fresno conference room, staring at a map covered in red pins. Each pin represented a household that had just received something in the mail that would change American society forever. They weren't sending money, they were sending debt. 60,000 families in Fresno, California had just received unsolicited credit cards in their mailboxes. No applications, no credit checks, no consent. Just instant access to borrowed money they never asked for. It was the largest financial experiment in American history, and it worked exactly as planned. Today, the average American household carries $6,194 in credit card debt. The total is $1.13 trillion nationwide. But this wasn't an accident. It was the intended outcome of a carefully designed psychological and economic control system. This is the story of how Bank of America didn't just invent the credit card. They invented financial slavery and convinced Americans to thank them for the privilege. Before 1958, buying something you couldn't afford was difficult, embarrassing, and socially unacceptable. You saved money, then you bought things. Or you went without. Department stores offered layaway plans where you paid over time before receiving merchandise. Some stores provided charge accounts for trusted customers, but they required personal relationships, character references, and full payment each month. Credit existed, but it was formal, limited, and carried social stigma. Borrowing money meant admitting financial failure. This created a problem for American capitalism. If people only bought what they could afford, economic growth would be limited by savings rates and income. The economy needed consumers to spend money they didn't have. Enter Bank of America, CEO Joe Williams, and his head of consumer lending, Joseph "Joe" Morell. They had a radical idea. What if debt became normal, convenient, and socially acceptable? But they faced massive obstacles. Americans were psychologically resistant to debt. The Great Depression was still fresh in collective memory. People associated borrowing with desperation and financial irresponsibility. Williams and Morell needed to overcome centuries of cultural conditioning that viewed debt as moral failure. Their solution was brilliant in its simplicity. Make debt feel like money. The credit card would eliminate the psychological barriers to borrowing. No embarrassing conversations with loan officers. No paperwork. No waiting periods. Just instant purchasing power that felt exactly like cash. But first, they had to solve the chicken and egg problem. Merchants wouldn't accept credit cards without customers. Customers wouldn't want credit cards without merchant acceptance. Their solution was the Fresno Drop. They would simultaneously mail 60,000 credit cards to every household in Fresno while signing up local merchants. Create instant adoption on both sides of the transaction. September 18, 1958. The Bank AmeriCard launch began. But this wasn't just a product launch. It was psychological warfare against American financial prudence. The cards arrived with letters designed by marketing psychologists. The language was carefully crafted to reframe debt as convenience, access, and sophistication. Congratulations! You have been selected for this exclusive financial service. No more carrying cash or writing checks. Shop with confidence and security. Pay at your convenience. Notice what's missing. Any mention of interest, debt, or financial obligation. The cards were positioned as a premium service, not a borrowing mechanism. The psychological manipulation was sophisticated. Recipients felt chosen, special, and sophisticated. Using the card felt like joining an exclusive club, not taking on debt. Within weeks, Fresno's economy transformed. Consumer spending increased 30%. Merchant sales rose across all sectors. People were buying things they had never considered purchasing. But the real genius wasn't the cards. It was the payment structure. Bank of America introduced something revolutionary: the minimum payment. For the first time, borrowers could carry debt indefinitely while making tiny monthly payments. Previous credit required full repayment. Credit cards allowed permanent debt servicing. Borrowers could pay 2% of their balance monthly and never reduce the principal. They became permanent income sources for the bank. The minimum payment was psychological genius. It made massive debt feel manageable. A $5,000 purchase became a $50 monthly payment. The total cost and timeline were obscured by small, digestible numbers. Meanwhile, compound interest worked silently in the background. A $1,000 purchase at 18% interest with minimum payments would cost over $3,000 and take decades to repay. But customers only focused on the small monthly amount. By 1959, Bank of America had identified their target psychology. They weren't selling credit. They were selling lifestyle, status, and instant gratification. Marketing campaigns featured affluent families making elegant purchases. Credit cards became symbols of sophistication and financial success, not debt and obligation. Television commercials showed confident professionals using cards in upscale establishments. The message was clear. Smart, successful people use credit cards. Cash was for the unsophisticated. They coined phrases like financial flexibility and purchasing power to reframe borrowing as strength rather than weakness. Debt became a tool of the financially savvy. The psychological reframing was comprehensive. Credit cards weren't debt instruments. They were lifestyle enablers, status symbols, and marks of financial sophistication. Within 5 years, the credit card industry exploded nationwide. Every major bank launched competing programs. Americans were carrying multiple cards and accumulating unprecedented personal debt. But the transformation went beyond individual behavior. Credit cards restructured the entire American economy around consumer debt. Businesses adjusted pricing strategies, knowing customers had access to borrowed money. Products became more expensive because consumers could afford higher prices through credit. The entire retail industry shifted toward encouraging immediate purchases rather than thoughtful saving. Buy now, pay later became the dominant commercial message. Economic growth became dependent on consumer borrowing rather than productive investment. The economy required Americans to spend money they didn't have to maintain growth and employment. By the 1970s, personal debt was no longer stigmatized. It was normalized, expected, and economically necessary. Americans had been successfully conditioned to view borrowed money as their own money. Credit card companies refined their psychological manipulation techniques. They studied spending behaviors, payment patterns, and debt tolerance levels. They discovered that plastic money felt less real than cash. Consumers spent 12 to 18% more when using cards versus cash. The physical act of handing over bills created psychological pain that swiping eliminated. Card companies optimized everything to maximize borrowing. Colors, fonts, materials, and even the sound of card machines were designed to encourage spending and minimize payment anxiety. They introduced rewards programs that created psychological positive associations with debt accumulation. Customers received points, miles, and cashback for borrowing money, making debt feel profitable. The industry developed sophisticated credit scoring systems that ranked Americans by their profitability as borrowers. The best customers weren't those who paid off balances. They were those who carried large debts while making minimum payments. Credit card companies began targeting specific demographics with tailored psychological appeals. College students received cards emphasizing freedom and independence. Parents received cards emphasizing family security and convenience. They identified life events that increased debt vulnerability: divorce, job loss, medical emergencies, home purchases. Marketing campaigns specifically targeted people during psychological stress periods when financial decision-making was impaired. The credit card industry created a permanent debt class. By the 1990s, the average American household carried revolving debt that would never be fully repaid. They had become subscription customers for banks, paying monthly fees for permanent access to money they didn't have. Today's Americans live in the World Bank of America created in 1958. Personal debt is not just normal, it's required for economic participation. Want to rent an apartment? You need a credit score. Buy a car? Credit history required? Get a job in finance? Credit check mandatory. Build wealth? Credit access essential. The system has evolved beyond simple borrowing. Credit scores now determine housing access, employment opportunities, insurance rates, and social mobility. Americans must participate in the debt system to access basic economic rights. Modern credit cards carry interest rates between 18 to 29%. The average household pays over $1,100 annually in credit card interest. That's money transferred from working families to financial institutions for the privilege of using borrowed money. But the psychological conditioning is so complete that most Americans view credit cards as financial tools rather than control mechanisms. They genuinely believe they're managing debt rather than being managed by it. The numbers reveal the system's success. American household debt has increased every year since 1958. Consumer spending consistently exceeds income. Personal savings rates have plummeted while debt service payments have soared. The credit card experiment worked perfectly. Americans have been successfully conditioned to transfer wealth to financial institutions through voluntary debt servicing, while believing they're receiving valuable financial services. So what can you do about it? First, understand that credit cards are not convenience tools. They are behavior modification systems designed to extract wealth from your future income. Every purchase is a psychological test of your resistance to financial manipulation. Second, recognize that minimum payments are mathematical traps. They're designed to maximize total interest payments while minimizing psychological payment pain. If you carry credit card debt, prioritize paying above minimums or consider debt consolidation at lower interest rates. Third, use cash for discretionary spending. The psychological pain of handing over physical money helps restore natural spending resistance that credit cards are designed to eliminate. Fourth, question the consumer culture that credit cards enabled. Many purchases driven by credit access aren't based on genuine needs but on manufactured desires created by companies targeting borrowed money. Finally, understand that building wealth requires reversing the credit card psychology. Instead of borrowing to buy depreciating assets, save money to buy appreciating investments. Use the debt system's tools, credit scores, business credit, to build wealth rather than consume products. The credit card industry succeeded in reframing debt as financial sophistication. Reversing this requires recognizing that true financial sophistication means using money you actually have to buy things that actually increase in value. September 18, 1958. The day American financial freedom ended and debt servitude began. 60,000 families in Fresno received cards that would reshape American society around voluntary wealth transfer to financial institutions. The experiment succeeded beyond its creators' wildest dreams. Americans now work longer hours, retire later, and stress about money more than any generation in history, all while believing they're more financially sophisticated than ever. Joe Williams and Joseph Morell didn't just invent a payment method. They invented a control system that extracts wealth from working people while convincing them they're receiving valuable financial services. The red pins on that Fresno map weren't marking customers. They were marking the beginning of America's transformation into a debt-based society where financial institutions own your future income, and you thank them for the privilege. Understanding this history won't eliminate credit cards from modern life, but it can help you use them as tools rather than being used by them as a profit source. The game was rigged from the beginning. But knowing the rules means you can stop playing by someone else's design and start building actual wealth instead of servicing permanent debt. What's your experience with credit card debt? Has this changed how you think about the convenience of borrowing money? Share your thoughts in the comments below. Let's discuss how to break free from systems designed to keep us financially dependent. If this hidden history opened your eyes to financial manipulation you never noticed, hit that like button and subscribe for more deep dives into the economic systems that shape our daily lives. We expose the stories behind the financial world that affects your wallet every day. Until next time, remember, when someone offers you convenient access to money you don't have, ask yourself who really benefits from your convenience.